Hi students, welcome to another lesson of accounting and finance. Today we're going to deal with the question of interim dividends. You remember from previous lessons we dealt with the final dividend that the company directors have the power now under the Constitution to declare, and then sometimes if they do have that power they can actually pay the dividend without shareholder approval. Well, with an interim dividend, we said that to keep the shareholders interested in getting two dividends a year rather than one dividend, then directors would normally pay a dividend part way through an accounting period. So an interim dividend is a dividend declared and paid part way through an accounting period. So if we look at a typical accounting period, which starts on the 1st of July and ends on the 30th of June, the final dividend, you remember, is paid after this date, and there's usually an AGM that takes place, and then the final dividend is paid. So usually the final dividend from the previous year is paid in the following year, around here. It makes sense then that the interim dividend would be paid partway through the period. So we're going to use as our example here an example of a company director that decides to pay an interim dividend on the 1st of January, and then that's going to be paid out on the 15th of January. So the directors will declare an interim dividend under the Constitution on the 1st of January, and interim dividends don't require any approval at annual general meetings. So it's paid, it's declared on the 1st of January and then paid on the 15th of January. Now the accounting entries are a little bit different here. Let's look first of all at what happens on the 1st of January. So on the 1st of January, on this date, because the dividend is declared and doesn't require shareholder approval, we debit an account called interim dividend, and we credit another account called interim dividend payable. And the calculation, if it's 5 cents per share, is 5 over 100. Let's assume we've got 100,000 shares, so the amount of the dividend is $5,000. So we debit interim dividend and we credit an account called interim dividend payable. When it's paid now on the 15th of January, we obviously write off that liability of 5,000. So on the 15th of January when it's paid, we debit the interim dividend payable and we credit our cash at bank account. A little bit different to the way that companies deal with the final dividends. So let's look now at what happens with this interim dividend account. That's sitting there $5,000. Now that's got to come out of the profit, which, yes, you guessed it, is sitting in the retained earnings account. So now on the 30th of June, that interim dividend account is offset against the retained earnings account. So it's got to come out of the profit for that year. And so we close this account off to the retained earnings on the 30th of June. So on the 30th of June, the interim dividend account is closed to the retained earnings ledger account, and in this way comes out of the profit. So on the 30th of June 2017, there's a debit to retained earnings and a credit to interim dividend. So let's look at the accounts. Let's summarise. On the 1st of January, the dividend was declared. When an interim dividend is declared, we debit an account called interim dividend and we credit an account called interim dividend payable. Then it was paid on the 15th. On the 15th, we debit interim dividend payable and we credit our cash at bank account, which is not shown here, but you can imagine the cash at bank account being credited. So now this interim dividend account sits there till the 30th of June. So I don't know if you remember from your Year 11 studies drawings, this is a distribution to the owners, so it's like the drawings account. So it's actually a negative EQ account. And because it's a negative EQ account, at the end of the period, it's offset against the retained earnings. And you can see that arrow there showing how that's closed off. So now on the 30th of June of that year, the interim dividend is offset against the retained earnings. So you can see here that the company had 5,000 sitting in the retained earnings account and used it to pay that interim dividend during that accounting period. The directors may now declare a final dividend, which is then paid sometime in October or November of that financial year. Thanks for listening, guys. If you want to take some summary notes, that would be a great idea. Enjoy your study of dividends. Thanks for listening.